One of the biggest advantages of working for a multinational company is that employees get stock options or RSUs, which is basically restricted stock units. In this video, I'm going to be talking about the declarations required by an individual who holds such stock options or RSUs and the tax implications at the time of sale of such stock options and also on the income from such RSUs. If you are an employee resident in India, and you hold ESOPs or RSUs in a foreign country, then this video is a must watch for you. I am Yashwan Nijagal, a chartered accountant in practice. Every week I post one video which will certainly provide you with valuable financial insights. If you are an employee working for an MNC, your compensation will usually be split into two parts. One is the cash component and the other would be the stock option component. So the cash component is usually credited to your account after all the tax deductions and other deductions, and the stock options will have a vesting period. And once the vesting period is completed, these stock options will be converted into regular shares and will be credited to your demat account, usually outside India. And this happens if the MNC is based from any country outside India. And these are what are called as foreign assets. So how do you file tax returns in such cases? The common mistake which is done by most individuals is that they declare the income from Form 16 and they leave out the part where they have been granted stock options, and that is available only from the statement which has to be obtained from the foreign stock broking company. Now, at the time of filing the returns, one, you will declare the income as per Form 16, and two, if you have sold any of these ESOPs or RSUs, you need to declare the details of the transaction in your ITR, and if there is any tax withheld in the foreign country, you need to file something called as Form 67 so that you can avail the benefit of the taxes which are already paid in the other country and pay only the remaining taxes in India. So the third point would be that if you have received any dividend or any other income on these stock options, you will have to declare that as well while filing your returns and pay taxes in India. And most importantly, if you hold any foreign assets, either in the form of stock options or RSUs or any other removable property, make sure the same is declared in a schedule called Schedule FA, which is basically foreign assets, at the time of filing your returns. And what are the implications if you don't declare this? Any income which is outside India for a resident and which is not declared in the income tax return can be treated as black money, and the individual can be prosecuted under Black Money Act. Some of my clients have missed to declare these details at the time of filing the returns for previous years. What can you do about it now? So you have an option to file something called as an updated return or ITRU, and while filing that you can declare these foreign assets or income from foreign sources and file the return so that you can avoid being prosecuted under Black Money Act. So tax filing for individuals who are salaried employees is very straightforward, but missing out on these smaller details can create a lot of issues. So make sure that you go to the right professional, give them all the information, and ensure that you are compliant with all the provisions of the Income Tax Act. No tricks, no hacks. Follow me for valuable financial insights.